Let's ask Aneta Markowska. She's the chief financial economist at Jefferies. Aneta, great to see you. You've already ruled out a 100 basis point rate hike. Is that right?
That's right. I think there is a very strong case to be made for not upsizing the move this time. You know, a month ago, we were very quick to upgrade our call for the Fed. But it really had less to do with the CPI and more to do with that UMISH number when it jumped, to 3.3%. That's what created the urgency to upsize the last move. Inflation sort of tells the Fed where they need to go ultimately, but inflation expectations tell them how quickly they need to get there. And there was a lot of urgency a month ago after that, spike in inflation expectations. Since then, inflation obviously continues to be pretty ugly, but inflation expectations have moved down pretty decisively.
Yeah.
It could be on the back of declines in gasoline prices, as you mentioned, but I think the Fed's basically done what they needed to do to restore credibility, and that now gives them a little bit more flexibility, and I think rules out another outsize increase at the next meeting.
What if they did only half a point? How would you feel about that?
I think that's very unlikely. They've guided very strongly and very decisively for 75. It would certainly be a surprise. I think if they did, move by 50 basis points, we would have to worry again about inflation expectations moving back up and then ultimately forcing their hand. But I think at this point, that's very unlikely.
So it's funny that and we've seen this even in Google searches, that they're spiking for both inflation and recession at the same time. And it seems to be that we have only those two very bad outcomes to pick from. But when I sort of read through your thoughts and what's happened over the past month here, it's possible we could see more of a Goldilocks second half, isn't it? I mean, I don't want to sound too crazy, but this has been a big reset if gas prices stay down. And meanwhile, we got some better data on retail sales. You highlighted it this morning. I mean, a 38% gain since 2019 is extraordinary.
It is extraordinary, and it highlights that actually a lot of these inflationary pressures that we're seeing are demand driven. But look, I agree. I think we're setting up for an environment that feels quite a bit better than it did over the past 6 months. If energy prices do stay here, CPI is on track to be flat month over month in July, right? And so if we continue to see similar nominal gains in income and in spending to what we saw in the first half, suddenly you're talking about real gains in consumption and a real acceleration in both real consumption and GDP. So while the first half was very disappointing, second quarter GDP will probably print around 1%. That's still very, very tepid, although not quite recessionary. But I think in the third quarter, we could see GDP back at 3.5% if energy prices stay down here. So it will feel a lot better, right? We've been in an environment of rising rates, slowing growth momentum, deteriorating sentiment, and I think that could change to where we are in a stable rate environment and growth momentum and sentiment that actually improve, at least for the next quarter or two.
Yeah, I guess the final piece of the puzzle is the labor market. And on that front, Larry Summers was out with some strong comments again today, saying that basically the Fed is too sanguine to think that the unemployment rate will stay low and not rise. And obviously, we know every time it's risen more than half a point, we're in recession and so on and so forth. I mean, do you think there's a Goldilocks outcome here where they're able to basically destroy job openings and slow wage gains without really creating a much bigger slowdown in the labor market?
I don't think that's possible. I think at the end of the day, if the Fed's serious about getting to 2% inflation, they're going to have to create a lot of slack in the labor market. Given the shape of the wage Phillips curve right now, our estimate is that in order to get back to about 3.5% wage inflation, which is consistent with 2% price inflation, you need to push unemployment to about 6-7%. And that's what we think the Fed will ultimately do. We just don't think that that's imminent. We think that process is still about 12 months away. Oh. And in the meantime, this is still a very strong economy that's actually going to be harder to put into a recession than I think many people think.
Well, I feel less excited about the back half if you think we're still going to be in recession sometime next year, no matter what.
Yes, but certainly it could feel a lot better for the next several months.
Enjoy it while it lasts. Yeah.
Enjoy it while it lasts. That's right.
All right, Aneta, we'll leave it there. Thanks for your time. We appreciate it.
Thank you.